Welcome to LexTalks Legal Topics, simplified the podcast that helps make Indian law just a little bit easier to understand for all you students out there.
Makes it fun, too.
Yeah, that's the goal.
Mm-hmm.
And today we're taking a deep dive into monetary and credit policy.
Oh, yeah, big one.
It's a dense subject, we know,
It is.
but it's crucial stuff.
Absolutely crucial for any aspiring Indian law professional.
We've got some great sources lined up today.
Yeah.
We're going to be looking at insights from the International Monetary Fund, the IMF.
Uh-huh.
We're going to be looking at the Bank of International Settlements, the BIS.
Right.
And, of course, we're going to be taking a close look at Indian banking law itself.
Can't forget that.
No, you can't.
The foundation.
All right, so let's just kick things off with the big player here, the Reserve Bank of India.
The RBI.
The RBI, they're like the conductors of the Indian economy, right?
Mm-hmm.
They use monetary policy to keep everything running smoothly, to keep everything stable.
Yeah, it's about balance.
What does that actually mean, though?
So the RBI is constantly juggling multiple goals.
Okay.
They want to keep inflation under control.
Right.
They want to make sure the economy is growing at a healthy pace.
Okay.
And they want to make sure the entire financial system is stable and resilient.
That sounds like a pretty tough job.
It is.
So how do they actually manage all that? What tools do they have?
Well, one of the most powerful tools is interest rates.
Okay.
You can think of it like a dial that controls the flow of money.
Oh,
If the RBI wants to encourage borrowing and spending, they lower interest rates.
okay.
And if they want to cool things down and curb inflation, they raise rates.
So if I'm taking out a loan to buy a car,
Yeah.
the RBI's interest rate decisions directly affect how much I end up paying.
Exactly.
Right.
And those decisions have ripple effects throughout the whole economy.
Wow.
Another key tool is reserve requirements.
Okay.
This is where it gets a bit technical.
Right.
But essentially, banks are required to hold a certain percentage of their deposits in reserve, either with themselves or with the RBI.
Okay, so picture this. I deposit 100 rupees into my bank account.
Right.
Because of these reserve requirements, the bank can't just lend out all 100 rupees, right?
Exactly. They have to hold back a certain percentage, say
Okay.
4 rupees as reserves.
4 rupees.
This is called the cash reserve ratio, or CRR.
CRR.
By adjusting the CRR, the RBI can directly influence how much money banks have available to lend out.
So if the RBI wants to encourage lending and stimulate the economy, they would lower the CRR,
Exactly.
giving banks more money to play with.
And if they want to tighten things up, they would raise the CRR.
Okay.
It's all a delicate balancing act.
Gotcha.
And then you've got open market operations where the RBI buys or sells government securities in the market.
Okay.
This influences the overall money supply and interest rates as well.
So the RBI really does have a lot of levers to pull.
They do.
But it's not just India operating in isolation, is it?
No.
We have to think about the global context.
Right.
So that's where organizations like the International Monetary Fund,
Yeah.
the IMF
Yeah.
come into play.
The IMF works with countries all over the world
Hmm.
on their economic policies, including offering technical assistance and guidance on monetary and credit issues.
So the IMF is kind of like a global advisor,
You could say
helping countries develop sound economic policies.
Right, and they're particularly focused on building capacity in areas like monetary policy, exchange rate regimes,
Okay.
and these sometimes confusing macroprudential policies.
Macroprudential policy.
Yeah, macroeconomics, the big picture.
Yeah, the big picture.
And well, macroprudential policies are about preventing big picture risks in the whole financial system, not just one bank.
So it's about preventing another global financial crisis.
Exactly like the one we saw back in 2008.
Okay, what I find interesting is the IMF's focus on transparency.
Yeah.
They've got that central bank transparency code. Why is transparency so important?
Well, imagine a central bank making decisions behind closed doors with no accountability.
Right.
It would erode public trust and could even lead to market instability.
Makes sense.
Wow.
If people don't understand why the RBI is making certain decisions, they might lose confidence in the whole system.
Exactly. Transparency fosters trust, which is crucial for a healthy economy.
Okay.
It also allows for better analysis and understanding of monetary policy decisions, both within India and by international observers.
So we've got the RBI conducting the orchestra.
Yeah, good analogy.
We've got the IMF providing global expertise
Mm-hmm.
and this overarching principle of transparency.
Right.
But what about the rules and regulations?
Yeah.
The actual legal framework governing all of this?
That's where it gets really relevant for us law students.
Well,
Absolutely.
Okay.
Let's dive into the world of regulations, starting with something called the Basel III Accords.
Basel Third Accords.
Yeah, these are international standards developed by the Bank for International Settlements, or BIS, aimed at strengthening the resilience of banks worldwide.
Right.
They focus on things like capital adequacy,
Uh-huh.
liquidity requirements,
Okay.
and limits on large exposures that banks can take on.
So making sure the banks are playing it safe and not taking on too much risk.
Exactly.
Yeah.
And here's where it gets really interesting.
Right.
A recent BIS report argued that while these new Basel III regulations are undoubtedly important for financial stability,
Okay.
their impact on the effectiveness of monetary policy might actually be pretty limited.
Really?
Yeah.
I would have thought stricter regulations would make it harder for central banks like the RBI to do their job.
You would think so, wouldn't you?
Yeah.
Well, one thought is that by creating a more stable and predictable banking environment, these regulations might actually make the RBI's actions more effective. It's a complex issue, though.
Okay.
And the BIS report acknowledges that central banks may need to make some adjustments to their operations,
Okay.
especially in a world of persistently low interest rates.
Interesting. So we've got Basel III setting international standards,
Yeah.
potentially with a less direct impact on monetary policy than you might think. But what about the specifics of Indian banking law?
Yeah,
How do these global concepts translate on the ground in India?
that's a great question, and it brings us to one of the most important pieces of legislation for Indian banking.
Yeah.
The Banking Regulation Act of 1949,
The Banking Regulation Act of 1949.
packed with provisions related to capital requirements, restrictions on loans,
Okay.
and the powers of the Reserve Bank to control how banks operate.
Wow.
For example, the act dictates how much cash banks need to keep on hand.
Right. We talked about reserve requirements earlier.
Yes.
So this is where those requirements are actually set out in Indian law.
Exactly. The Banking Regulation Act specifies the cash reserve ratio, or CRR, which we discussed,
Yeah.
and also the statutory liquidity ratio, or SLR,
SLR.
which is the percentage of deposits that banks are required to invest in government securities and other approved assets.
Got it. So CRR is about cash on hand,
Mm-hmm.
and SLR is about investing in specific types of assets.
Right.
Both ways for the RBI to influence how much money banks have to lend out.
You got it. And there's even a section in the Act on how banks should handle unclaimed deposits.
Unclaimed deposits.
Unclaimed deposits.
Wow, I never realized that was something that needed to be regulated.
It's all about maintaining order and stability in the financial system.
Oh.
Banks have to diligently report these unclaimed deposits to the RBI
Okay.
and eventually transfer those funds to a special fund managed by the central bank.
So the RBI becomes the custodian of these unclaimed funds.
Precisely. And while the original depositors or their heirs can still claim those funds, this system allows the RBI to utilize those resources for the broader benefit of the economy.
So it's kind of a win-win.
It is.
This is all fascinating, but I'm starting to feel like we've only just scratched the surface.
Oh, we have. There's so much more to explore.
I bet.
You know what's fascinating about these international standards, like Basel III?
What's that?
They might have a limited direct impact on monetary policy, but they still create ripples throughout the entire financial landscape.
Okay, I'm intrigued.
Yeah.
Explain that a bit more.
Okay, so think of it this way. Even if the RBI can still technically adjust interest rates or those reserve requirements without being completely hampered by Basel III,
Right.
those regulations change how banks behave. And that influences how those monetary policy changes actually play out in the real world.
So it's like a chain reaction.
Exactly.
The regulations might not be directly targeting monetary policy, but they create a whole different environment for those policies to operate in.
Yeah, exactly.
Yeah.
For example, let's say the RBI wants to encourage banks to lend more money to help stimulate the economy.
Okay.
One way they might do that is by lowering interest rates.
Right, making it cheaper to borrow.
Exactly. But if banks are simultaneously facing those stricter capital requirements under Basel
They
III,
might get cold feet
they might.
and think twice about lending out all that money, even with the lower rates.
Precisely. They might think, sure, rates are lower, but we still need to be super careful about who we lend to, or we might not meet those capital requirements and face penalties. It makes the whole decision-making process for banks more complex.
Okay.
And that can affect how well those monetary policy changes actually work.
This is why understanding how regulations and policy intertwine is so important.
Absolutely.
It's not just about knowing the rules themselves,
Right.
but understanding how they all fit together and influence the bigger picture.
Couldn't agree more. And speaking of the bigger picture, there's another layer we need to consider.
Okay.
The current global economic climate.
Right.
We're living in a world of historically low interest rates.
Yeah.
And that throws another wrench into the mix when it comes to how these regulations interact with monetary policy.
Ooh, this is where it gets really juicy, right?
It certainly adds complexity. You see, these regulations often change the relationship between the policy rates set by a central bank, like the RBI,
Okay.
and the actual market interest rates that businesses and individuals encounter when they go to take out a loan.
Okay.
In a low interest rate environment, this can make it even tougher for central banks to stimulate the economy.
Because even if they push those policy rates down further, hoping to encourage borrowing,
Yeah,
the market rates might not follow suit as readily.
exactly. And this can create a situation where central banks need to resort to more unconventional measures,
Okay.
like something called quantitative easing,
Quantitative easing.
which involves buying assets to inject more liquidity into the market.
Okay.
But here's the catch. These unconventional measures can sometimes have unintended consequences when combined with stricter regulations.
Unintended consequences. Now, you've really got my attention. What kind of consequences are we talking about?
Well, for
Like,
example, quantitative easing can put downward pressure on banks' leverage ratios.
leverage ratio.
Remember those leverage ratios we talked about earlier?
Yes, the ratio of a bank's capital to its total assets.
Right,
Basically, a measure of how much debt they're using to fuel their operations.
right. So when the central bank buys assets from banks through quantitative easing, it increases the bank's reserves, which are counted as assets. This can, in some cases, actually make it harder for banks to meet those leverage ratio requirements.
Hold on, so it's like a paradox.
It is a bit of a paradox.
The central bank is trying to stimulate lending by pumping money into the system.
Yeah,
But that very action might make banks even more reluctant to lend because they're worried about those leverage ratio constraints.
you got it. And this just highlights how intricate and interconnected this whole system is.
Wow.
It's a constant balancing act between promoting financial stability,
Uh-huh.
stimulating economic growth,
Right.
and navigating the complex interplay of regulations, policies, and market dynamics.
I have to admit my head is spinning a little, but in a good way.
It's a lot to take in.
It's amazing to see how all these seemingly disparate pieces connect to create this intricate economic and legal tapestry.
It is.
It really highlights the intellectual challenges and complexities that await our aspiring law students out there.
Absolutely. The legal world is rarely static, especially in areas like banking and finance law. Understanding these dynamic systems is absolutely key.
And speaking of navigating complexities, we're going to dive even deeper into the specifics of Indian banking law in our next segment.
Yes, we are.
We'll explore how provisions in the Banking Regulation Act directly impact how banks operate and how these regulations shape the financial landscape in India.
We'll unpack how seemingly mundane things like those unclaimed deposits we discussed actually play a crucial role in maintaining stability and order within the financial system.
So stay tuned for even more insights on this fascinating topic.
It's going to be good.
We'll be back in a flash to unravel the mysteries of the Banking Regulation Act.
Okay, so the Banking Regulation Act of 1949, we touched on the cash reserve ratio and the statutory liquidity ratio. But I'm guessing there's a lot more to this act.
Oh, there's a lot more. This act is like a treasure chest of regulatory wisdom.
Oh, wow.
Covers everything from the very basics like licensing requirements for banks
Uh-huh.
to the powers of the Reserve Bank to inspect and even control how banks operate. That's a lot of power. It sounds like the RBI really has a firm grip on the banking sector.
It does, and for good reason. The RBI's role is to ensure the stability and soundness of the entire banking system.
Makes sense.
And that requires a pretty robust regulatory framework.
Okay.
One really interesting aspect of the Act is how it addresses the issue of unclaimed deposits.
Oh, right. Unclaimed deposits. That's not something I would have immediately thought of as a major regulatory concern.
But it's important.
Okay.
Unclaimed deposits represent funds that are essentially sitting idle,
Right.
which isn't great for the economy as a whole.
Okay.
The Banking Regulation Act requires banks to be very diligent about reporting these unclaimed deposits to the RBI,
Uh-huh.
and after a certain period, to transfer those funds to a special fund managed by the central bank.
So the RBI is like a caretaker for these unclaimed funds.
Exactly. And while the original depositors or their heirs can still claim those funds,
Right.
this system allows the RBI to utilize those resources in a way that benefits the broader economy. It's a
Yeah.
win-win.
Yeah. I like it, but I'm starting to see how this act is like a finely tuned instrument addressing all sorts of intricate aspects of the banking system.
It is a finely tuned instrument.
Yeah.
And one of the most important aspects of this framework
Okay.
is making sure that banks are well capitalized.
Right. We talked about capital adequacy earlier, but why is that such a big deal?
Well, imagine a bank with very little capital relative to its assets.
Okay.
If some of those assets go bad, say borrowers start defaulting on their loans,
Yeah.
the bank might not have enough capital to absorb those losses.
Oh.
Could even lead to the bank collapsing.
I see. So it's like a safety net, both for the bank itself and for the whole financial system.
Precisely, the Banking Regulation Act sets out specific capital requirements for banks,
Okay.
ensuring they have a sufficient buffer to withstand those financial shocks and protect depositors' funds.
So we've got the RBI controlling the flow of money with things like interest rates and reserve requirements.
Yeah.
And it can also directly regulate the behavior of banks through laws like the Banking Regulation Act.
That's the beauty of this complex and interconnected system. It's a multifaceted approach to maintaining both economic and financial stability.
It sounds like, well, we've covered a lot of ground today, from the global perspective of the IMF to the intricacies of the Banking Regulation Act. But before we wrap up, what are some key takeaways for our listeners, especially those aspiring Indian law students out there?
I would say the most important takeaway is the sheer interconnectedness of everything we've discussed.
Okay.
Monetary policy, credit policy, international standards, domestic regulations, it's all part of one big complex web that shapes the financial landscape.
And understanding how those pieces fit together is absolutely essential for anyone who wants to work in banking and finance law.
It is absolutely, you can't just memorize the rules. You need to understand the economic principles behind them, the policy objectives they're trying to achieve,
Right.
the potential challenges and unintended consequences that can arise. It's about seeing the forest in the trees.
Well said. Another key takeaway is that this field is constantly evolving.
Oh, it is.
New regulations emerge, policies shift, and the global economic landscape is in a constant state of flux. Lifelong learning is a must for anyone working in this field.
Absolutely. The key is to stay curious, stay informed, and never stop asking questions.
Couldn't agree more. And on that note, we'll leave our listeners with one final question to ponder. We've talked about how these monetary and credit policies are designed to influence the economy at a macro level.
Yeah.
But how do they actually impact the lives of everyday Indians? How do these regulations affect the businesses we interact with, the loans we take out, and the overall financial health of our communities? Think about that as you continue your legal studies. Who knows? Maybe you'll be the one shaping these policies in the future. Thanks for joining us on LexTalks, Legal Topics Simplified. Be sure to subscribe and join us for more fascinating discussions on all things law.